we doing? Straight into it. J. Jill came up on the screener, put a blue tick or blue flag beside it, as you can see. So, one to watch, that means, for those of you who don't know, red is interested, blue is, could be interested. So, yeah, J. Jill, let's get into it. It is let's get it up here. I got my thing here. Apparel retailer, women's apparel retailer, focus on upscale casual clothing and accessories. Apparently serving women over 40 and over. Focus on comfort, quality fabrics, and timeless rather than fast fashion. So they own around 247 stores in the US, and they got e-commerce site as well, and obviously catalog sales from apparently a legacy thing. You know, I remember the old catalogs back in the day. You order it from, and then it got sent in the post. I'm guessing that's similar. I don't know. I'm guessing on that one. Probably should have done the research, but it's not a huge portion of their business now. So, you've got two primary channels: retail stores and e-commerce channels. Basically, so it's almost around 50-50 split between retail, buying it in the store, and buying it on the internet. And they're basically exclusively in the United States. They're not really anywhere else. So before we get into it, right, I always look up the DEF 14A here to see how much percent of beneficial owners there are. So around 4.4% is owned by insiders. Annoyingly, I don't like this, but this is the last 2 years. As you can see, there's nobody in Jill that is purchased. They've all sold, all of them sold, so that's unfortunate. I don't really like that. But when it comes to institutional investors, this here, Towerbrook investors, they own 48% of the business. So it's difficult when it comes to that sort of thing, right? Because that's almost people with control. You wouldn't really have a say compared to them in the business, but it also shows that there's people that are deeply invested in this. It is definitely in Towerbrook's interest for Jill to succeed. So there's an upside to it. You know, when people got large ownership stakes, you can pretty much guarantee that their ideas should be aligned with yours, in that they want the business to do well. So swings and roundabouts on that, but generally I believe that's a positive thing to see. So I would say we've broken it down basically 50-50. If we get I'll just drag this one off of here a minute. If we get is it this one? Yep. So pretty consistent revenues, to be honest. They have had a couple down periods, but this is during COVID, so I'd imagine a lot of this is due to the store closures. If they're 50-50 and they've got stores and they've had to close, then, you know, that's a large portion of it, I would imagine. 600 million, you're looking at constantly around about 600 million for the last 5 years. So revenues are very consistent. Revenues are very consistent. Now, this here is actually something which is quite impressive, in that their gross margins are around about 70% and have been for a while. They've been plus 60 for a long time. As you can see, the entire time that we're on this screen, all the way, look, plus 60, above 60. Now, we look at this document here. I've got this from Aswaf Demorduran's website. Now, this is an average for the industry. So the average gross margin for the apparel industry is 54%. So they are way above that. So that is a very well run business ultimately when it comes down to it. SG&A though is reasonably high. Industry average is higher than the industry average. I think I got that on here as well. SG&A industry average. We see, have a look. Average SG&A margin with 5. So what have I got on there? 57. Yeah, so it is above. But you know, the gross margin at least is showing that the costs on that side of things are very good. So there's margin pressures due to tariffs on this. Obviously the imports of the materials needed to manufacture the clothes and all that sort of thing, or not just that, import of clothes, because I'm imagining probably, I haven't looked into this, which, as I said, this is just a quick overview. I'd imagine a lot of the stuff they actually import clothes ready-made. There's also there's been a significant portion of their business that have been doing markdown and clearance. Q1 numbers missed, revenue missed estimates, and comps were worse than expected. So basically, when a retailer shows that, you know, it's got shrinking top line and shrinking comps, it signals weaker demand or competitive pressures. So, you know, we've seen quite a sell off in the stock, which is why it's come up on my screener. It wouldn't come up otherwise, because everything I'm looking for is, you know, trading in the gutter. It just happens to be, you know, where a value investor tends to look, and I am a value investor. So that's where we're at. The retail sector is quite challenging at the moment, and unfortunately as well, which doesn't help stock price. The guidance was withdrawn on what future revenues and all that were going to be. Basically, to combat the decline, they've stated that they're going to target a reduction in markdown and shift to full price selling, inventory reduction. But that said, that can be a problem if they go too far. They've got 25 million to repurchase shares. They've maintained the quarterly dividend, but if they used the whole 25 million, it'd only be around 1.6 million shares, and at the current price, that won't really affect any of the multiples. I don't believe there is a lot of debt though, which is good to see. So long-term debt, you know, 70 million. They've got 45 million of cash on the books. So, you know, what else have you got there? Inventories. It depends. Like if they're gonna stop with the markdowns, and some of the inventories could be all right, but retailer inventories in a fire sale, they tend to go for bugger all. So, you know, current assets are all right. Huge leases, right? So the leases highly affect the debt ratios on here. Is it on here still? No, not this one. We'll get into that. So most of the debt is actually operating leases, without the operating leases classified as debt. Because the thing with operating leases is it's not like true debt. All right, you can't get out of true debt. Well, there's no real ways around true debt. With operating lease, you can close the store, and for the remainder of the lease, you can re-lease the place. So there are ways around, you know, cutting a large portion of that out. You know, you still own the lease, but somebody else is paying you, you know, for that property. So there are ways around it. Yeah, a significant portion, have you seen, of the debt is operating leases. Sorry, down here, operating leases at 114 million. I was in the wrong one. So the total liabilities, you know, close to half is operating leases. Well, half is operating leases when you count the current portion. So it's not, from my point of view, from Keith Gill's point of view, I believe Michael Burry feels the same way. From that point of view, it's nowhere near as levered as it looks. So if you were to take that away from it, take the operating leases away from it, and don't treat it as true debt, it is debt, but is it true debt? That's the question. Tangible book value actually be $10. So at the current price of, what are we, 14? You know, that's not too bad. Goodwill and intangibles are 1/3 of total assets. But this is good to see. We like this. Return on capital is pretty good. 24% simple free cash flow. This is against EV and EBIT as well. 30%. It has been much higher historically. So this is a pretty well run business. I would say, from my point of view, at least, it seems like a pretty well, in my limited experience, it seems like a pretty well run business. Revenues are down by 9 million year on year. SG&A has been cut. Has it been cut? It might have been cut on the thing, because mine's rolling to 12 months. So net income's only down around about 2 million year on year. Is that correct? I'm starting to question myself now. Where are we? Here we go, got there in the end. Yeah, so 2 million down there. So, despite a fall in revenues of 9 million, net income's only down 2 million. So there is that. And in the most recent quarter as well, it's actually up. Net income is up compared to this time last year. So whether that's starting to potentially signal some sort of, turnaround, we never know. We'll see. So going on to the cash flow statement now. Simple free cash flow of around 45 million. Historically, it's been slightly higher, but 40s, it seems to be where you're looking. 40s. Historically, there's been a few down years, a few better years, but it seems to be around about the 40s. Interest expenses only 11 million. They've cut down on their total debt, so interest expenses dropped, so that's good. You've got more than enough cash. You've got where are we? Interest coverage ratio of 4. Yeah, interest coverage ratio of 4, which is obviously above what it has been previously. Basically, the highest it's been since we've got it on the screen at least. Net cash as well is around 218. So that's I got this as arcade because this came from one of his videos, that it's a more conservative free cash flow. So if free cash flow is around about $3, this is more conservative because it obviously takes into account the other investing costs, but $2.18 is still pretty good. Will give you a 9 times multiple to price. No, it wouldn't. It'd give you less than that, 7. So yeah, the average. Let's have a look at what the average is. We take that up against the average. Drag this up here. Look. I said these are not my figures. This is Aswaf, the Mordoran's figures. So currently, average EV to free cash flow for an apparel is around about 9 times free cash flow. For luxury apparel, it can go up to 12. So with at 9 times the conservative 218, you're looking at like $19 a stock, $19 a share. So it's around about 5 above where we're at now. Free cash flow yield as well. I want to see this above the 10-year US Treasury. So free cash flow yield 15%. Against EV, so you're way above the 10-year Treasury there. I said 45 million comfortably covers the interest expense. Net cash as well comfortably covers that. The more conservative one, 33 million in net cash. So if you had, where are we here? $2.96. Got my graphic calculator. I should be able to do this in my head, but I can't. 296 times 9. It should be around about a $26 stock based on historical multiples. Now, obviously, the problem you've got is that they withdrew. I can't drag that up. There it is. Withdrew the guidance. Let's see. So I suspect that the guidance has killed the stocks. Now, if we take it against peers, cheapest on EV to sales. Book value is high, price to book value is higher, price to tangible book value is higher. But the EBIT multiple to EV is the lowest. EBIT multiple to market cap is the lowest. Simple free cash flow to EV is the lowest. Simple free cash flow to market cap is the lowest. Gross margin is the highest by a mile. Operation margins are highest by a mile. Net income margins are highest by a mile. Interest coverage is not the best, but I want to see above 3, so it's pretty good. Debt capitalization, so it's round about average on that. But from the performance side of it, they're better than the comps that I've been given. Gap was one of them, and I can't remember who this one was, Chico's or something like that. So it seems like a really well-run business. Like I said, Jill's the best margins by far, cheapest multiples by book value and tangible book value, by far the cheapest cash multiples and EV to sales. And the debt metrics are quite skewy due to operating leases, but I would imagine as retailers that would be the same for the other two as well. So there's probably not too much to read into that. So I've copied and pasted it in here, so we haven't got to go back to the screen. So if you used 550 million due to the guidance withdrawal, so that's, you know, on average around about 600 million. So you're potentially looking at probably a bit low when you see that revs have only dropped 9 million in the first half. Due to margin pressures because of tariffs and all that, I only use 50% of the average 3-year free cash flow margin and EBIT margin. So on that, it's a higher than the 9 multiple. There you go. That would return 149 per share, 22.7 million. But these are very conservative figures, right? And then a 10 multiple. I've got my other analysis here as well. So you know, if you actually use the actual tangible book value of 155 million, so when I do my net cash, my discounted cash flow, which is, there we go, present value, future cash flows. So for the next 5 years, I've said that they're going to earn around about 590 a share. That is in total for the next 5 years. You add that to what the actual 89 million to the 155 million of tangible book value, you know, you'd be looking at around about $16 a share. The balance sheet looks really good, I think, without the operating leases, but the inventory can be heavily marked down in a fire sale, so it looks cheapish on, you know, conservative metrics. I have set an alarm on this one to drop lower. I don't think it's worth buying now, but it is a considerably better business than its peers. It has traded significantly higher. Whether or not it gets any lower though, because technically we're at a bottom here, and then, you know, you would be in a range here, which is about up to 50% in that, but I don't know. I'd like to see it cheaper before I would consider buying it. But there could be something in this one. It is a better business than its peers. Not cheap enough for me at the moment, but getting there. So we'll see. Right. Thank you very much. On to the next one.